financial advisors, planning for life. Wealthway Financial Advisors, planning for life.
And good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zivna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation or anything I'm talking about tonight, jump on the phone lines. Give me a call, 627-7979. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air. 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interest ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth individuals, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday at 6 p.m., and that's to reach out and help as many people as we can in the Hampton Roads listening area achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone, give me a call, 627-7979. Whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, TSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella of personal finance we are here to discuss tonight. All right, tonight we're going to talk about how to build a financially stress-free retirement. So many people assume that retirement confidence comes from having more money. And to a certain extent, that there's an element of truth to that. Adequate resources do matter, but portfolio size alone doesn't really explain why some retirees enjoy life with confidence, while others, and sometimes with more assets, worry about every purchase and every market headline. And there's probably two main differences that determine, or two main activities that determine why there are differences in outlook when it comes to retirement. And one item is the habits that are built before retirement in the retiree. And then the other is the systems used after retirement begins. So confident retirees generally understand where their income comes from, knows what they can spend, expect markets to be uncomfortable at times, and then they update or revisit or revise their whether it's a written financial plan or a financial plan that they have in their head, but they update that and they adapt as life changes. Anxious, nervous, scared, or uncomfortable retirees are more likely to make each decision from scratch, with no thought and with no plan, or at least with not much of it, which turns normal uncertainty then into like repeated stress, because you don't really know what the implications of each decision are. So tonight we're going to discuss the 4 habits that help families move from the financially independent to actually feeling financially confident. And the goal is not to eliminate uncertainty. We can't do that, of course. Is to build enough structure around your financial retirement life that uncertainty no longer controls every decision. And I should say that confidence is not the same thing as certainty. A good plan cannot predict every event. There are no facts about the future. We can make assumptions, we can use statistical analysis to increase our probabilities, but there are no guarantees and there are no facts about the future. So we have to have an acceptance of that element of uncertainty first, and then an acknowledgement that we aren't going to get everything right on the front end, but we can prepare for a range of outcomes. And we can have plan B and plan C in effect or ready to go if plan A changes. So why do retirees with similar wealth feel completely different? Imagine the scenario. We got two different couples. They both retire at 65. They have similar savings. They got similar Social Security benefits. Homes nearly paid off. And we see in one couple, they travel comfortably. They gift to their grandkids' college funds. They spend comfortably without constant second guessing. And then maybe the other couple checks their account balance every day, maybe the market several times throughout the day. They postpone or delay ordinary purchases, and they treat every little market blip or every inflammatory headline as evidence that the retirement is going to fail. They're going to run out of money. So the financial statements, their financial foundations are very comparable, very similar, but their retirement experience is completely different. One very positive and healthy, the other one filled with fear, doubt, and uncertainty and anxiety. And the difference isn't about their investment portfolio. It's got nothing to do with which mutual fund, which stocks, which ETFs, which bonds you hold, you buy, you sell, you invest in. None of that really comes into much play when it comes to retirement confidence. It's more often that the daily structure around money, the difference in the daily structure between the couples, how income is organized and accounted for, how spending decisions are made, how market volatility is handled, and then how often they revisit, think about, revise their overall comprehensive retirement planning. And therein lies the difference with how they approach retirement, how they go through retirement. And oftentimes we'll hear some phrases that I think give some people some false confidence. You often hear like, well, once I reach a certain number, I'll stop worrying. Once I hit $2 million in my 401k, then I'll be set and I'll be good. Well, oftentimes we hear people get to 2 million and the next thing they want to do is get to 3 million. There's never a limit to how much money you can try to accumulate. It's how much you're going to be satisfied with. Therein lies the difference. Also, a corollary to that, more money automatically creates more confidence, some people think. And as I acknowledged on the front end, a certain amount does. That's true. Having more money than zero improves your confidence, that's for sure. But after a certain level of wealth, for most people, not all, it starts to reduces its utility in terms of how much more it means to them. And so having more doesn't necessarily mean you're going to have a more comfortable, carefree retirement if you don't have the right framework around it. So some of the most confident retirees are not necessarily the wealthiest. They're the people who understand financial planning well enough, though, to express their situation in plain English, like at a high level. Like, I know kind of how much money I have coming in each month. I kind of know how much I spend each month in a normal month. I know how much I have for discretionary spending in terms of gifting, charities, travel, splurging on indulgences that I've now earned the right to afford because I've saved this money. They can kind of articulate the differences there. They have a sense of what their monthly income looks like, which expenses can change and what they'll do when things don't go exactly according to plan, because they all often don't. And so having an acknowledgement in the beginning that life is not going to be a straight line, that there's going to be some twists and turns in there, and then having some backup plans in place to navigate those, all that goes into putting your mind at ease. And our job as financial advisors is to get people to that point of comfort and peace of mind, where we can lay out at a high level and speak to them in language that they can understand, that makes sense to them, that they're either in a good place, and here is what we think is a reasonable spending number that you can enjoy for the rest of your life and increase that number for inflation. And here's what's going to happen when the market takes its next, has its next pullback. This is how we're going to react. This is what we're going to do or not do in that particular situation. We're going to lay it all out in advance, and a good financial advisor should be communicating to their clients where the person stands and giving them that peace of mind. Or if they're not quite there yet, if it might be a little too soon to retire and maintain their existing lifestyle, then what can we do now? What steps can we take today to get to that place so that the client does build that confidence? So that's kind of what we see in real life. And that I'm reminded of a client we had a while ago, a retired engineer, and they're some of the most tricky to deal with. They're they hyper analyze minutia in detail, and I think sometimes don't see as big the fuller picture. From time to time, they get lost in the weeds. But a retired engineer, he had more than enough assets to support his current lifestyle, yet every time he took money out of the account, he felt like he was going backwards, like it was a loss, like he shouldn't be doing it. And that's absolutely not the case. And he kind of had to be talked out of that, trained out of it, taught out of it, that no, that's okay, that what you're spending from, that is part of the plan. And the amount you are spending is comfortable, it's sustainable, and by the way, here's backup plan B in case we have to make a detour somewhere along the way. And it took a while, but eventually we're able to get that former engineer to a place of peace and comfort in retirement. But they're some of the most tricky ones to work with, because they always want to get down deep into the numbers and the weeds, and then sometimes lose sight of the big picture. But it can be done. So financial independence and financial confidence are not the same thing. Independence, you can be financially independent, meaning you have enough assets, enough money to live the lifestyle that you desire. Financial confidence, though, comes from knowing that you can spend that money with a high degree of probability without fear of running out. Confidence comes from understanding the plan, not memorizing every account balance or checking the market daily, from understanding the general direction you're heading. Retirement is a psychological transition from accumulation to intentional use. And that is a big switch for a lot of people to flip, especially those who are responsible, diligent in their savings habits, maybe and have delayed certain sacrifices, have made certain sacrifices and delayed gratification over time. Those people have a real hard time going from transitioning from accumulating, saving, building up the 401k, the IRA balances, to now intentionally using it. And we have to remind them, hey, what did you do all this for anyway? Why are you saving this money? Why did you save this money? To one day not have to earn a paycheck in order to support my existing lifestyle. And it just needs to be reframed a little bit. So comprehensive financial planning done right can be liberating. It's actually freeing. It gives you permission to spend in ways you probably otherwise would not, which means it can materially change the way that you live your life and what you do with your life. Good financial planning and advice enhances the quality of life if it provides you with a healthy, optimistic, stress-free retirement. We're going to talk about more of how to get there after we come back from this break. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. All right, tonight we're talking about how to build a financially stress-free retirement. Retirement confidence, it's kind of like, when you're flying in a plane and you hit turbulence, like there's always going to be some turbulence at some point. Everyone feels the bumps. You can't eliminate those. But the confident passenger trusts the flight plan and the pilots and the flight crew, and the anxious passenger interprets every bump as the plane's going down, right? They're on the same plane, they're experiencing the same things, but each reacts to it differently. So a good financial plan does not eliminate the turbulence. It gives you the confidence to stay in your seat and order another drink when you hit the turbulence and not get up and panic and make a scene, right? So the foundation of a good, solid retirement, confident retirement, is to kind of replace some of the activities and the actions of the pre-retirement world. For like, we work for like 40 or 50 years of our adult lives, and most people work for a company where they get a W-2 type of paycheck. And they organize their life around the paycheck. They know when the money arrives. They know the bills it's going to cover. They know kind of how much is left for saving or spending. But then retirement strips all that away. There is no more paycheck that you get every 2 weeks or twice a month. Social Security, sure, if you turn that on once a month, you'll get that. But for most people, that's not going to support their entire lifestyle. They're going to have to live off their investments, their savings, to supplement Social Security. And maybe there's a pension too that would help provide some stability. But for most of us, it's going to be relying on ourselves to build the retirement that we choose. So retirement removes all that familiar structure and the routine of the paycheck. And so even if you have substantial assets saved up, but if every withdrawal is making you feel uncomfortable, panicky, then you can still feel financially exposed. So at Wealthway, what we do is we replace the employment paycheck with a retirement paycheck to replace some of that familiar stability that people are used to enjoying when they work for another company. So clients then can understand which income is predictable, which income depends on the portfolio, which accounts will be used first, how taxes affect the amount that they can actually spend, and what we will do and not do when the investment markets go through their occasional but inevitable temporary pullbacks. And so by having that all laid out on the front end and having the stability of a retirement paycheck that looks, feels, and acts much like your work paycheck that you got, is the first step to putting people at to giving them a good peace of mind. Some kind of interesting facts from Social Security Administration: about 87% of U.S. population age 65 or older was receiving Social Security benefits. So 87% above 65. And then the estimate rises to 93% of the population for 75 older. So, almost everyone at some point is going to get Social Security payments. And for most households, Social Security is therefore a central layer of their retirement paycheck. This is important. And so Social Security when to claim Social Security is an important and generally irrevocable decision that requires thoughtful consideration, because ideal claiming age differs from person to person. And so that factors in. That's probably another, in addition to the retirement paycheck, when to claim the Social Security paycheck is like 1A and 1B in terms of questions that clients typically ask. When should I claim Social Security, and how much can I spend from my portfolio are the two biggies. We get those right, that goes a long way to calming people's nerves. All right, got to pause right here for the news. We'll be back in just a couple minutes. 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. Or if you got some nuanced questions, want to speak to a live human being, give us a call at the office, 456-2200. Want to remind everybody, our next live show will be in 2 weeks on Tuesday, August 11th. But if you can't catch us live every second and fourth Tuesday of the month, get this show as a podcast. Search for Dollars and Common Sense wherever you get your podcast. Download us, take us with you where you go, and listen at your convenience. And for those of you into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors, hit that like or follow button, and once every week or two we put up a interesting and informative financial planning post to hopefully keep you engaged in the process. All right, tonight we're talking about how to build a financially stress-free retirement. Talked about timing of Social Security being a big pillar of that. And then the other one, building a retirement paycheck from your hard-earned savings and investments that you spent a career building up. And so what we do is using computer modeling, sophisticated statistical analysis, we can then give our clients a reasonable and sustainable spending number from their portfolio that we believe can withstand the overwhelming majority of market pullbacks and temporary declines. But even past that, if we do have to make an adjustment, then we build a plan B into the circumstance as well, so that we have to temporarily, if conditions are such that we have to temporarily reduce or suspend how much we are sending from the portfolio, in other words, cut their retirement paycheck, then we already have a plan B in place, usually in the form of a overfunded bank account, money stable value at your fingertips, close at hand, that we would purposely have our clients draw down on temporarily to make up the difference in the reduction in the retirement paycheck. And so their lifestyle never misses a beat. And they don't have to worry about what's going on in the market on a daily basis. And they don't have to worry when we get an official bear market of 20% decline in the S&P 500, because we've already planned for it. We've accounted for it. And we know what we're going to do when it happens, or not do when it happens. And just having that certainty of the reliability and the stability of the regular paycheck, and knowing that if it's prudent to sometimes cut back on it, that we have another a bucket to pull from that is easily accessible and totally liquid, and that once we get the inevitable market recovery, we're going to replenish that safety bucket as well, just takes a load off of people's shoulders. So you get the retirement paycheck that's reasonable, sustainable, have a plan B, get Social Security claiming right. Now that we know what we can spend, we give our clients permission to freely spend from their portfolio if the analytics support that. So a retirement plan should answer two questions, like how much can we spend and how will we know when that amount should change? And without those answers, then the retirees often fall into one of two extremes. You get some people who overspend because there are no boundaries, there's no rules, there's no structure, there's no plan. Let's live for today, let's forget about tomorrow. It's too complex, we can't figure it out. I'm going to spend it while I have it. I can't take it with me. Okay. Yep, that's one sort of response to that. And then the other is the underspenders, because every purchase feels dangerous. I don't know if I can spend this money. Is this too much? What happens if the market declines 30%? Will I be able to keep this up? Will I be able to maintain my lifestyle? I'm not sure, so I better not spend as much as I want to, just in case. Because you don't really know without doing the math, without doing the planning around the distribution. So most importantly, confident retirees recognize that enjoying money for its intended purpose is not a planning failure. It's one of the primary reasons that we do financial planning, so that you can get to a place of financial security, and then confidently and comfortably use the money that you've earned throughout your lifetime to enjoy your life. Employee Benefit Research Institute, they did a 2024 retirement confidence survey. Half of retirees said their overall expenses were higher than they originally expected. And that finding supports that building margin into a plan rather than assuming retirement spending will always decline. So just build some cushion in there. And that same survey found that nearly 4 in 5 retirees were able to spend money how they wanted within reason. That's a good number. And more than 2/3 said that they were having the retirement lifestyle they envisioned, 2/3. These results suggest that higher than expected costs do not automatically prevent a satisfying retirement when the plan allows room to adapt. So while people kind of think they're going to be okay at their current spending level, what they don't know is what is possible. And that's something that we kind of hear frequently once we get a new client on board at Wealthway, is I never thought I could spend this much money. I didn't think that it would be sustainable and reasonable for us to spend this much money from our savings. Now, as long as you remain a little bit adaptable, have a plan B in your back pocket, then yes, then we give our confidence professional permission to go enjoy the money that they spent a lifetime savings. Gift to the grandkids, gift to their kids, take the trip, go first class, spend an extra 2 weeks in Europe, buy the vacation house, get the luxury automobile. Go ahead. You've earned the right to do it. But without the analytics of the planning, most people don't feel like they can do it. So, A common misconception that we've heard, I could probably do a whole show around this. A successful retiree lives off investment income and never touches principal. That's what some people think that you do when you get to retirement. And I think that's still a Depression era holdover. That, yes, okay, we invest in stocks, but we can only live off the dividends that those stocks throw off, the interest in our savings account, the dividends in the investments, in the mutual funds, and we'd never sell a share of our principal. No, that is an old, outdated, antiquated way of thinking about portfolio management, about investment management, and the spending policy that you can develop off of your investment portfolio. No, you can't. You will unnecessarily underspend what you could over the course of your lifetime, which means you're just going to pass a whole bunch of money onto your kids and grandkids that didn't sacrifice as much as you do. So just thinking that that you need to live off the investment income and you need to fit your lifestyle around that, that's old, outdated, antiquated thinking. Here's something that we tend to see is more typical. Longtime savers often find spending harder than savings. They build their identity around the discipline, some of the short-term sacrifice, and the period, at least up until retirement, of lifelong accumulation. Like they're achievers. Like, at one point I want to get to 500,000. Then I want to get to 1 million. Then I want 2 million. 5 million, 10 million, and always and more and achieve. And there's certain gratification that comes from that. But at some point, for most of us, it becomes enough. And then the eternal question is, how much is enough for you and your spouse and your family? How much money do you really need to live a purposeful, content, happy life? The answer is different for every single person out there, pretty much. But you don't know what is possible until you do the math, until you build and go through the planning process. So retirement asks those types of people to do the opposite of what they've built their entire life doing, right? Work hard, be thrifty, be responsible with your money, save as much as you can, invest wisely, grow it over time. Now you're like, okay, I get to retirement. Now guess what? You don't have to do any of that stuff anymore. Well, maybe you still have to. You do have to invest responsibly, but you don't have to save as much. Saving is over at that point. You can spend. There's no need to save. Now you are going to purposefully, intentionally spend the money that you built a lifetime saving because you've earned the right to do that. And it's a hard habit for those types of people to break, but it's something that we work with our clients on, because if you don't do that, then think of all the missed experiences, the missed opportunities, how much more giving you could have done to your church or your university or to charities near and dear to your heart. How many other people's lives could you touch with the wealth that you have created if you know that you can give freely and responsibly? Think of how much less your life could be if you don't intentionally spend what you spend a lifetime building. So, first healthy retirement years are typically the best time for travel and experiences. And, the 60s and the 70s are, for most people, the healthiest, most active periods of their retirement, and also the most expensive, because you can do the most types of things. And that's okay. If you've earned the right to do that, you can. But we also know from professional experience that once people typically get into their 80s and their 90s, no matter how much money they have, their lifestyle is to the point that they don't want to spend as much as they used to spend. So really, we're talking, in many cases, a 10 to 20 year window of this retirement concept that is going to be in full bloom for you. So think of those numbers when you contemplate as you approach retirement what you want it to look like. Spending confidence improves when the plan is revised regularly instead of done once then put on a shelf. A financial plan in and of itself is of very limited value. Typically, once the ink is dry, something in the plan has changed, your life has changed to change the plan. And so a plan is not a static document, or I guess a plan is a static document, but it's not very valuable to most people. Ongoing analytical financial planning that happens routinely, that is constantly revisited and revised, that is exceptionally valuable. So usually the objective is neither, for most people, is not spend it all or preserve every dollar. Somewhere for most people, is where the happiness resides. The objective is alignment with with the family's priorities, and how can we use this money to enhance the quality of our lives. Going to talk more about it after we come back from this short break. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, look us up online at wealthwayadvisors.com. All right, tonight we're talking about how to build a financially stress-free retirement. And one of the aspects of that is discussing with clear eyes and honesty about the investment markets, about common stocks, one of the greatest wealth-building tools ever devised by mankind in human history, accessible to us all, where we can become fractional owners of some of the most profitable, best-run companies in the world, and we can piggyback off of their success and build our net worth through their profitability. But the reality is, it ain't a straight line, right? There are occasional, temporary, sometimes very meaningful and painful pullbacks in the valuation of equities, of stocks. And while it is an excellent vehicle used properly for building and maintaining wealth, it can provide us with moments or months, occasionally a year or two, of frustration and anxiety and worry. So we have to come to a sort of agreement with the investment markets. Market declines feel different after retirement because the paycheck is gone, and now you're living off those investments. And withdrawals may be coming from the same accounts whose values are falling, right? Confident retirees, though, no one enjoys volatility. So confident retirees don't enjoy volatility, but they expect it. They understand its role in a long-term plan, at least conceptually, at a high level. And they know what actions, if any, that they need to take in response to a market decline. Market volatility, is the price that we have to pay. It's what we have to accept in order to enjoy our long-run rates of return that can be 7, 8, 9, 10, sometimes plus % on average per year. That's the price of admission. And if you can't accept that, then you're probably better off never being an investor, because you're probably going to do the wrong thing at the wrong time, and you will probably lose real money. So an acceptance of the market, that stock prices go up and go down in the short run, and in the short run they can go down really hard, really far, really fast, and it can be really scary. But they've never gone, the market in general. The market in general has never, the S&P 500, we'll use that as the proxy, never gone to zero and stayed there, right? It's virtually impossible. A company can go out of business, which means that stock price is going to zero, stayed there, and you permanently lost that money. But that risk gets basically taken off the table with the modern invention of mutual funds and ETFs. But an acceptance and at least an understanding of market volatility at a high level. That's what we sign on for in order to enjoy the higher rates of return that builds our nest egg, that builds our wealth, that allows us to spend more money to live a fuller, richer life. The fear of the market decline, fear of a market decline in and of itself is not the problem. We all have the fear. We all have the anxiety. We all have the concern. Fear is normal. But the damage comes from allowing the temporary emotion of fear to trigger a permanent change, right? Selling out after the market's already declined 30%, locking in those losses. Don't let the fear trigger a permanent change. Abandoning the investment strategy, selling after decline, freezing spending without examining whether you could maintain spending at your current level. Right? Don't let those things dictate your action. So one of the things we see in real life, anxious investors often consume more financial news. News designed to agitate, to get you to pay attention to them. They tend to be more reactionary, more nervous. They check accounts more frequently. They feel pressure to do something when they see their investments are declining. Confident retirees, though, usually have fewer decisions to make because their plan has already been defined, and the investment mix, the income reserves, the rebalancing process, all the circumstances that would justify a change have already kind of been worked through, been thought about, and been planned for. So emotional discipline is part of the return. The planning is designed to protect, right? You've got to stay emotionally disciplined through the down periods in order to enjoy the up periods, the undeniable long-term upward trend of equities. Cash reserves can help that behavior, building an extensive emergency fund, and then a plan should define what would cause a change before the uncomfortable moment arrives. Remember, thinking ahead, planning ahead. All right, going to wrap things up here tonight. We're going to be back in 2 weeks, live show on Tuesday, August 11th at 6 p.m. as usual. But in summary, retirement confidence comes from the process, not perfect forecasting, right? No one can really tell you with 100% certainty what the future will hold. But we can tell you probabilities, and we can tell you ranges. And that provides a level of peace of mind. Confident retirees build that retirement paycheck instead of relying on ad hoc withdrawals. Regular, sustainable, monthly withdrawals of regular amounts. They know what they can spend, and they understand which expenses they can adjust. They expect market volatility and avoid turning temporary fear into permanent decisions. And they treat financial planning as a living process that evolves with their life. So financial confidence is not a personality trait just reserved for Alfred E. Newman's What Me Worry, just people who are chill. No, it's the result of repeatable habits. Organize the income, define the spending, stay disciplined, keep the planning fresh. Those habits do not guarantee a perfect retirement, but they do make a changing retirement far easier to navigate, to give you the peace of mind to live your best life. And that's the ultimate power of money. I'm certified financial planner Kevin Zivna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.